I think, yay, we are getting live. So excellent. Thank you, everyone, and welcome to our session on how to leverage personal expenses as business deductions. We had a lot of interest in this webinar. We had over 60 people registered, which is amazing. So hopefully more of those people will be dialing in shortly, as we've got a few attendees in here, but nowhere near the 60 registered attendees. And I think this is a really important session. Because when it comes to deducting business expenses, every dollar that you're able to deduct as a business expense is a dollar that you don't have to pay any taxes on. And of course, a lot of benefits that come out of being an independent contractor is the ability to be able to claim business deductions. And a lot of those deductions are deductions that you would have had while you were an employee and unable to claim as a deductible business expense as a T4 employee. So today we're going to be covering some of those, and of course, sorry, my slideshow is giving me a bit of an issue. I'm going to have to stop the slideshow. Joys of technical problems. There we go. And I just have to swap my screens. Sorry about the technical hurdles here, everybody. Hopefully my screen is sharing all right and you guys are able to see everything. And so for those of you who are not familiar with us, my name is Andrew Wall. I'm the managing partner here at CPA4IT. We've been specializing in service-based professionals and independent contractors since 1984, when my father, George Wall, founded Wall and Associates Professional Corp. I've taken over and blended his years of wisdom with my passion for technology. We've been fortunate to be recognized for a number of awards around the industry. And we're also members of the National Association of Computer Consulting Businesses, which is like a lobby group for the independent contracting community. And one of the things that also makes us unique is that we are ISO 9001 registered, which means we have unique products and services. So if you're interested in learning more about us, Rach, are you here for a reason?
Yeah, I'm just on his.
Two girls are working on Dodo.
Rachel, your video is sharing on the screen.
One second, one second. Did you say something?
Yeah, Rachel, can we turn off your camera? I'm gonna stop your video there. And let me actually gonna move you to an attendee. Sorry guys. I apologize for that. Yeah, enough about us. If you guys want to learn more, check out our website, CPA4IT. We have lots of these events that we have about every 2 weeks. And I encourage you to come and check these out. In today's session, we're going to talk to you a little bit about understanding business deductions. We're going to go through some things that you can claim, things that you can't. So why don't we start with actually what constitutes a business deduction? So there's a couple of criteria when it comes to a deductible business expense. It must be incurred with the intent of earning business income. Sometimes there's not always a straight line from the intent to the bottom line, but there has to be an intent with that expense to help you earn business income. They must be reasonable, and both reasonable and intent are subjective, as is whether the expenses are directly linked to business activities, which again can be somewhat subjective. We'll talk a little bit more about that as we go. They must also be documented with receipts or other appropriate records, and they must not be specifically disallowed by the Income Tax Act. So with the exception of the documentation and the income tax requirement, a lot of this is open to interpretation. And we feel that our job as your accountants is to help you understand what you can deduct, as opposed to many others who might feel that their role is to tell you what you cannot claim. And so in Canada, having a business structure is an amazing opportunity, even though the Liberals are taking away more and more of those amazing opportunities every year. And don't worry, we're going to have another session about the budget. We've got it queued up and scheduled, where we're going to have some economists come in and talk to you about the budget, as well as we'll come up with some new strategies for how we'll deal with this new rate for capital gains exemption. But there are a lot of benefits to being able to be incorporated, and one of those is having the ability to deduct these business expenses, especially when you can take what would be normally lifestyle expenses that you had already and be able to claim those. So there is a difference between a deductible lifestyle expense and a non-deductible lifestyle expense. And so we should start with a clarification between the two. So those that are deductible are ones that can be claimed against your income and reduce your taxable income, and they have to meet those criteria we talked about earlier. You have to have the intent to help your business earn income. They must be reasonable, and they must not be specifically disallowed by the Income Tax Act. Whereas non-deductible lifestyle expenses are those costs that are more personal in nature and don't relate in any way to earning income. You can think like diapers and stuff like that, childcare expenses, those types of things which you can't claim within your business. And some of the examples that we'll talk about include those that are disallowed by the Income Tax Act, which are most notably golf green fees. Now you can claim the drinks and the food that you consume on a golf course, but golf green fees are one of the things that are specifically disallowed. So I always tell people, if you are a golfer, I encourage you to pick up the drinks and have your friends pick up the round, especially if they're employees, because then you can claim all those drinks. Now, in addition to golf green fees, club memberships like golf club memberships, country clubs, gyms, again, are specifically disallowed by the Income Tax Act, as is personal entertainment. Personal entertainment not specifically disallowed by the Income Tax Act. And in fact, there are forms of entertainment that you can claim for deductible business expenses, which we'll be going through later. But if it's your own personal entertainment, you're going to watch the Leafs, with you and your kids, probably hard to justify that as a deductible business expenses. Another big one worth noting is things like clothing and personal accessories. Now, this is important because this is a big change from those of us who've been clients for decades. You know that this is something that we used to strongly encourage. And the weird thing about clothing and personal items, like grooming and haircuts and cosmetics, is that, well, there's nothing in the Income Tax Act that says you can't claim it. CRA has an internal rule and bulletin that they will disallow any business clothing that is not a uniform. And they have a number of court cases that they've won that they use to justify that. Now, because this is not specifically disallowed by the Income Tax Act the way club memberships are, we will allow clients to claim clothing and personal accessories with the giant caveat that, hey, if CRA reviews these and sees personal clothing and personal grooming, that they will likely disallow those expenses. Now, you can argue that this was for business reasons and this is your form of the uniform, and I think that there is potentially an argument there. But what is likely to happen is CRA is going to disallow those expenses, and they're going to disallow them all through the 3 levels of appeals that you have within CRA. And then it's up to you whether you want to take it to tax court. And most people aren't going to take that to tax court, which is where we have the fundamental problem. Unfortunately, we have people who did take it to tax court without a very good case to back them up. And they created a precedence, which CRA now uses to deny the expenses. We have our very first question, which is, what about medical expenses like dental or glasses, since we don't have insurance? Unfortunately, if you do not have insurance, and insurance under the corporation's name, like a health and dental plan, or either a health spending account, which is quite common for businesses, you cannot claim those in the corporation. Now, you could potentially claim those on your personal tax return, but there are some caveats there. It has to be above a certain threshold. It's a percentage of your income. And then you only get to claim what is above that percentage, which is why a lot of businesses will opt for a health spending account or some type of benefits package with an insurance provider. And what a health spending account is an insurance product that allows you to claim it under a business expense, and then the insurance provider will charge you a cost plus. Typically, it's about 10%. So you pay about 10% more than you would if you were to pay it out of pocket to be able to deduct the entire amount. So those can be helpful for small businesses that are looking to claim those things like dental and glasses. And of course, there's also going to be there have been some changes with coverage for dental from the federal government. And if you don't have an insurance plan, that gets claimed on your T4 now. So that's a fun new process for us when it comes to preparing your T4s. So I hope that answers your question, Rob. Getting back to these expenses that you can't claim, there are a few other things that are specifically disallowed by the Income Tax Act. Things like your primary home telephone line. That's considered a basic necessity. You can't claim that. Also, life insurance is specifically disallowed. But life insurance does have a bit of a caveat. It's got a couple caveats, actually. One, if there's a bank covenant requiring it, it can be deductible, which is not going to happen for anyone who is a small business who's a notice to reader. Those only happen typically for businesses, larger businesses with significant bank loans that are required to do either a review engagement or an audit engagement as opposed to a notice to reader engagement like we're preparing for our clients. The other caveat is that while you can't deduct it, you can still expense it in your corporation and it gets added back on your T2, which what that effectively means is you're able to pay for that expense with money that has been taxed at the corporate tax rate, which is only 12.2% here in Ontario, versus money that has been taxed at your personal tax rate, which can be as high as 54% depending upon your tax bracket. So there are, a couple things that are specifically disallowed. But to be honest, outside of those main categories, there's not that many things that are specifically disallowed by the Income Tax Act. Everything else really comes down to these things that are more like interpretation, like personal clothing and personal grooming. And what we're going to go through today is some of the categories that you can deduct, where it's typically a more common sort of lifestyle expense that some of you who have been clients for a while will probably know you can claim. And others of you that are more new to us may not be aware. So probably the largest, let's call it lifestyle expense that you can claim is your home office expense. Now, this is not the entire costs of your home. It is a percentage of your home as it relates to your business use of that home. And typically for the average person, that's probably in the 15 to 30% range, with the average probably being closer to 20 to 25. And there's a couple of ways of calculating your percentage of use. It can either be the proportionate size or the number of rooms. And you can use whichever method gets you the best deduction. We've also got a unique way of calculating the percentage of use that helps you maximize that deduction. And what we do when we look at percentage of use is we look at the total square footage of the home, but we're going to add to that the garage space if you have one where you're parking a vehicle that you're using for work. And we're going to subtract from that the common areas, which are the kitchens, the hallways, and the bathrooms. And that's going to become the denominator of your percentage of use calculation. And the numerator will be the office space plus the garage, which assuming you're using the vehicle for work. And that's going to take someone who might be at a 10 or 15% percentage of their home office expenses up to 15, 20, 25%. And that's important because we know interest rates are going through the roof. And when it comes to your home office, if you own, you can claim your mortgage interest, not your principal, but your mortgage interest, your property tax, your utilities, and even any repairs and maintenance that you're doing to the property. Now, when it comes to repairs and maintenance, it is important to know the difference between a capital improvement and a repair and maintenance. The easiest way to understand a capital improvement is if you are changing the value. And this can be a little bit confusing because if you take out old crappy hardwood and you put in brand new hardwood, you might think that you're changing the value, but you're not. You're actually restoring it to its original condition. Whereas another example, you take out a deck, you replace it with the same size deck, restoring it to its original condition, repair and maintenance. But if you take out a deck and make a larger deck, that would be considered a capital improvement. Just like with the floors, if you take out carpet and you put in hardwood, that would be considered a capital improvement. And we don't claim capital improvements in the business because that could put your capital gains exemption on your primary residence at risk. And we never want to do that. Now, some people are worried that if they claim their home office expense, could they be putting their capital gains exemption at risk? And no, there's a special rule that says if it's less than ancillary use, which, 25 to 30%, not an issue. We have had situations where people have gone as high as, 49%. I would never encourage that, and we usually don't recommend going above 30%. But there are cases where people have gone all the way up to 49% and still claimed it and not been challenged. Now, that doesn't mean that you couldn't, if you claimed 49%, you wouldn't be challenged. But it is a risk that we wouldn't recommend taking because the capital gains exemption on your primary residence is such a large benefit, you don't want to put it at risk. And a lot of this is, we're going to come down to risk versus reward, because clients have various levels of risk tolerance. And you might be super aggressive, whereas someone else might be more conservative. And you have the choice to make with all of your expenses as to how aggressive you want to be. Because like I said, a lot of the criteria for what is a deductible expense is actually subjective. And what's most important is that you feel comfortable sitting across the table from an auditor saying, this is why you think it's going to help your business earn income. This is how it relates to your business. And this is why it's reasonable. If you feel comfortable doing that, I encourage you to claim as many business expenses as possible, because the only person who really truly knows that is not the auditor. It's you, the business owner. And what a lot of people don't realize when it comes to deductible business expenses is it's not ultimately up to CRA to decide whether something is deductible. They have an interpretation just like you have an interpretation. And you have 3 levels of appeals within CRA, which if you're a client of ours, you've likely got an audit representation protection, and we'll represent you up until that 3rd and final stages of appeals. And even if we can't convince the 3rd level of appeals that this is a deductible business expense, and by the way, as you go up the levels, you usually get more senior, more experienced people who are, generally speaking, more reasonable. Not always the case, but typically the case. But even if you fail at all 3 levels of appeals, you have the option to go to tax court, and it's ultimately a judge that determines whether this is a reasonable business expense. But I want you guys to feel comfortable in being able to claim as much of these lifestyle expenses as you possibly can by shifting your mindset from this concept of an employee mindset where you work for someone else and none of your expenses are deductible, to a self-employed individual where your business is your life, and every aspect of your life relates to what you do in your business, from learning and development and relationships, and nurturing and fostering those relationships. And those can turn into a multitude of business expenses that you can claim. And I know, Ritesh, we have another question from you about vehicle lease, which we're going to come to in just a second, because we have that in our slide deck here as far as one of the categories we're going to talk about. But before we do, some examples of some of the things that you can claim include a portion of the heating costs, electricity costs, water and sewer charges, property taxes, home insurance, landscaping, and even decorating costs, as well as the mortgage interests and potentially condo fees if applicable. And if you're not an owner and you're just renting, we can claim the rent. And there we also eliminate that whole concern about percentage of use going above 30%, because there's no capital gains exemption to worry about. But now on to Ritesh's question about what about a vehicle lease taken in the corporation name? And if I can get my slide to work, we're going to go on to automobile. Yes, you can absolutely claim your vehicle lease. And in fact, it doesn't even need to be in the corporation's name. And in fact, we typically don't recommend you put leases or purchase vehicles under the corporation's name for a number of different reasons. One is there are some, if you're not using the vehicle for 100% business use, then we have to put a taxable benefit on the T4, and it becomes a lot more work and a lot more complicated. Not to mention, there's a gain and loss at disposal, and we have to worry about all of that, as well as tracking the asset on the balance sheet. However, if you own the vehicle personally or lease it personally, the corporation can still reimburse you for its share of the use of that vehicle, as long as it's obviously used for business activities. Now, keep in mind, business activities don't only include driving to and from work. They can also include going out for meals and entertainment, going to the bank, going to the store to pick up supplies. So there's a lot of mileage expenses that are often overlooked by business owners. And when it comes to deducting your automobile expense, it is important to note that the logbook is essential. And someone at CRA has figured out that most small business owners aren't keeping a logbook and can't be bothered to recreate it if they get audited. So it is a highly audited expense category, because if you don't have your logbook, you are going to be denied your automobile expense. Now, again, you do also have to be claiming it for business activities, and you also can't claim mileage driving from your home to your work. However, what you can claim, which is a very important thing, is driving from your home office to your client site, which is very different than driving from your home to your work. So that's important to know that difference. And if you don't have a home office, then you are going to lose a lot of the mileage that you can claim for business use if you're driving out to client sites. So make sure that you keep that logbook. Make sure that you have a home office and that you are tracking these. And by the way, logbooks now absolutely can be digital, and there are amazing pieces of technology that can do this for you. There's sensors that you can plug into your car. There are apps for your phone. In fact, one is free, comes with QuickBooks Online if you are using QuickBooks Online. So it's not free, but it's included in your subscription there. There's other ones that you can pay for. I strongly, strongly encourage you in getting some sort of mileage tracker, because we see way too many small business owners lose their automobile deduction because they haven't kept a mileage log and they can't be bothered to recreate it. Now, when it comes to deducting your automobile expenses, there's a number of things that you can claim. And there's actually two methods in which you can claim business expenses. So you can use the actual, which would include a percentage. And again, we're going to do a percentage of use calculation, which is your business kilometers over your total kilometers, to figure out what the percentage of use would be. And then we take a percentage of your fuel, your repairs, your license fees, everything related to your automobile, right down to the insurance and oil changes, and even your leasing costs, as you asked earlier. And if you're not leasing and you own, we can take amortization or depreciation. And there's a set calculation, which is 15% up to a maximum purchase price. There's different maximum for an EV versus a regular vehicle. We'll help you figure out all those amortization calculations. You just need to tell us what you paid for it and when you bought it. And we can take a percentage of that maximum. It's 15% in your first year and 30% of the remaining or declining balance for each subsequent year. But you can claim the actuals, taking a percentage of use, or what a lot of business owners do is they'll take the mileage. So all you have to do is track the business mileage. There's a set formula that does change over time. And we use that set formula to calculate the business expense for your automobile. And I strongly, strongly, strongly encourage people to keep track of both. And you can flip-flop from one year to the next and choose whatever method is best for you. And what I would tell you is, in a post-COVID era, a percentage of actual often works out better than the mileage rate because a lot of people aren't going to client sites anymore, right? And they're not even driving nearly as much. So typically, a percentage, because if your total driving has completely decreased, you probably still have a relatively high percentage, and your costs really haven't decreased. If anything, they've probably increased with, fuel prices and carbon taxes and all those fun things that, like I said, I'm not a big fan of our Liberal government and the taxes that they've been giving us, but I digress on that. So yes, absolutely, you can claim your automobile, but we do need to take a percentage of this. And lastly, we do recommend that you own or lease the vehicle under your personal name, as it makes it a lot easier for your accounting records and doesn't change what you can claim as far as a business expense. The other thing I want to talk about is meals and entertainment expense. Now, meals and entertainment expense is a great example of a lifestyle expense that you probably had, because most of you probably go out for meals with your spouse or your partner, and we're not being able to claim that before in the past. But as a business owner, your spouse is your business partner. You talk to them about how your day went. You talk to them about what's going on in your life. They are your, financial partner, financial advisor, life partner, confidant. And there is, in our opinion, more than a reasonable justification for claiming meals and entertainment with your spouse, as well as potentially other family members like parents who might act as coaches and advisors in your life, as well as friends who might help you grow your network. And there's a very easy way to claim the majority of your meals and entertainment cost, because the reality is most people that you're going to spend time with in having a meal are going to have a big impact on your life. And if your life is your business, then absolutely it's going to have an impact on your business and help your business to earn income in the future. And, generally speaking, it will be, for most people, reasonable. And the average person is probably about $3,000 to $4,000 of meals and entertainment expenses in their business, which is a healthy deduction for sure. If you're the person who eats out every single day, you're probably going to run into a reasonableness issue there. But again, what we look for a good judgment as reasonableness is a percentage of your income and looking at how it relates to your total income as well. Now, the other thing about meals and entertainment is that the government recognizes that you are getting a personal benefit out of this meal that you're having. And as a result, you only get 50% of the deduction. So if you spent $100, you would claim $100, and there's an add back on your tax return, and 50% of it will not reduce your deductible, or will not reduce your revenue. So let's say that you had $100 of revenue, and you spent $100 on a meal and entertainment. You're going to have 100 minus 100, which is 0, but then they add back 50. So you'll have a net income of $50, and you'll pay tax on half of it. But this is, again, just the corporate tax. So the personal benefit that you're getting out of it is, well, not deductible, is still paid for with money that has been taxed at the corporate tax rate of only 12.2%, as opposed to whatever your marginal rate might be personally. And this could include restaurants, sporting events, theater tickets, networking events, entry for recreational events, and of course, including all the gratuities, taxes, and cover charges that might go along with it. The one caveat that we would say to this is typically for you having a meal with one or two other people, because if you do have a wider target audience that you're making this available to, like you can think like a New Year's Eve party or something like that, where you're inviting a group of people, you can potentially claim this under an advertising expense. And the advantage of doing that is that the advertising expense isn't subject to that 50% add back that we talked about earlier. It is 100% deductible. Now, again, when it comes to reasonableness, it's probably going to be hard to justify that you're having a business event every single week. But, if you're having, one a quarter or something like that, probably perfectly reasonable. And that doesn't necessarily have to be at a restaurant, that might be held at your home, and you might take the groceries and the alcohol related to having that event, and absolutely legitimately deductible under advertising. And again, it's all about networking, relationship building, which is critical to being a service-based professional and building and growing your networking to help you get the next opportunities. Now, in addition to events, in advertising, you can also have, traditional sort of promotional gifts and swag, as well as, non-traditional gifts. But the rule here, though, is that if it is over $100 per individual, then anything over $100 should not be deductible. So you can claim gifts, usually up to $100. Now, there's no limit on the total number of gifts that you can give. So you could have well over $100 in gifts, but to the one individual, it should be $100 per recipient. But you can also have, these events that we talked about. You could also have traditional advertising in magazines and online, as well as social media, which also includes things like LinkedIn memberships. Those types of things would typically fall under advertising as opposed to websites and stuff like that. And again, things that you might have had before to help, your career, but as an employee weren't deductible. Now, as an incorporated or even self-employed individual, these are deductible expenses. Now, some other categories and things that you can also claim include your cell phone and your internet. Again, common expenses that most people have, that as an employee, you're not really able to claim. And clients always ask us, can I claim 100% of it, or do I have to claim a percentage of it? We do allow 100% because we think you need to have that available for the business at all times. And you can think, if you had an employee and you're paying for their phone, you would give them 100% of the expense, and you wouldn't just give them 50% of the expense, even if they did use it for personal phone calls here and there. Training and education, or seminars and workshops, again, are going to be deductible. So ongoing, continual sort of professional development. And along with that is travel expenses related to business activities. Now, if you're going on a vacation down to the Caribbean, you probably can't claim that. But if you're going to a vacation in the Bahamas and there's a conference in the Bahamas that you're also attending, you can definitely claim the airfare there. You can certainly claim at least the days of the hotel that are there that coincide with the conference. So you can certainly claim a percentage of that. And there's also other reasons you might travel for business, which might include real estate investment. If you're looking at investment opportunities, even if you don't end up buying a property, if you can demonstrate that you went to look at properties and that you had, you've got the funds in your corporation to potentially invest, and that you looked at investment opportunities, you could potentially claim travel down to even Caribbean destinations as potential investment opportunities for your business. And so, yeah, there's literally no end to this list. What I want you to think about is that this is an introduction to the types of things that you can claim. And if you're unsure as to whether something is deductible or not, if you're a client of ours, I would encourage you to put it under your general expenses. Let us review it with you at the end of the year, because it's always better for us to take something out than it is to get to the end of the year, run a benchmark analysis and see that you're well below the average, and then ask you questions and add things in. And the reason I say that is because imagine if you were an auditor and you've got two sets of books in front of you, and they both have the same revenue, same expenses, same net income. But in one of them, you see all these adjusting entries from the accountant that says to add, meals and entertainment, to add travel, to add internet. And then you see in the other one to remove personal portion of, advertising, to remove personal portion of meals and entertainment. Which of those to you looks more reasonable, and which looks more aggressive? And it's just simply a presentation and what they see, and helping them to make this go through the process as smoothly as possible. And optics are a big part of that. So it's important to remember that. Now, we've covered quite a few things that hopefully you maybe were not aware that you could claim. And we've covered the mindset, which is the most important thing when it comes to understanding how to make lifestyle expenses deductible under your business. Is I want you going through life thinking about how this might relate to your business, not how it won't relate to your business. And as long as you could sit there across the table from someone and argue for why it will help your business sometime in the future and why it's reasonable, as long as it's not specifically disallowed by the Income Tax Act, that's a legitimate business deduction. And in a worst case scenario, if CRA disagrees with you and says, no, we do not think this is deductible, as long as you have what we refer to as a defensible position, as long as you have an argument for why it will help your business, you will have to pay the taxes that they are disallowing, assuming you don't challenge it. But you're not going to be hit with any penalties, right? Because you haven't done anything fraudulent, you haven't done any gross negligence. You've taken an aggressive interpretation, you have an argument for it, they just disagree with it. And in fact, if you wanted, you would have the right to go all the way to, the Supreme Court of Canada if you wanted to over those issues. But oftentimes what happens is people will get there, if they go through an audit, which by the way only happens about 1% of the population, but if they happen to go through an audit, the auditor will come back, maybe disallow some expenses. You'll argue your position, and it will almost be a type of negotiation because oftentimes auditors want to leave with something. And unless your books are perfect, odds are they're going to get something. But there is a way to make sure they get nothing, and that's to make sure that you got the documentation in place, which includes not only the physical receipts, but in things like meals and entertainment, who the meal was with, and the rationale for why it will help your business earn income. And then, of course, with reasonableness, making sure that everything is reasonable. So we got another question here, which is actually a great question. It's, does meeting with prospective clients in other countries fall under travel? What would you have to show as proof to be able to expense it? So absolutely, you may very reasonably be flying out to do an interview with another client. So you would have to be able to show who you had the meeting with, and that they are either hiring or potentially hiring, and that they could be a fit. Now, keep in mind that doesn't have to be an employer. It could be a supplier or a partner as well. But yeah, and the key is documentation, documentation, documentation. So evidence that you had the meeting, evidence that they are related to your business, and that they would actually be either potentially hiring you or working with you in some way, shape, or form. And again, I just want to close by letting everyone know that we are here to help. If you have any questions, feel free to reach out to our team. We do offer a free initial consultation. If you're new and thinking about incorporating, we do have a paralegal team in-house and can do those incorporations for you. We do offer the industry benchmarking to show you how you compare against the average and the median in our database, which I think is an important tool for clients who think they might be missing out on deductions. I encourage you to go back and look at your benchmarking analysis, look at any of those categories where you're below the average, and take a look at this now with this new, mindset of, hey, how can I reasonably justify that spending money in this category would help my my business earn income sometime in the future? And then, of course, we do back it all up with audit representation protection, which means we will defend you up until the third and final stages of appeals with no additional cost to you as long as you're on one of our prepayment plans. And of course, like I said earlier, we've been doing this since 1984, so we have decades of experience. Everything that we're telling you today has been tried and tested. It's not some new idea as far as whether you can claim these expenses. We have been through hundreds, if not thousands, of audits over the years. Got another question here from Alex, who asks, if a corporation is below average in expense, is it at a greater risk of audit? I would say probably not. So CRA absolutely loves it when you leave meat on the bone, so to speak. Where the things that tend to trigger audits are, this is weird, either massive swings year over year or no swings year over year. And again, it depends on the category because certain categories would not change significantly year over year, like say your home office or rent expenses and your telephone and internet. But say your advertising and business promotion, if it's the exact same number every single year, that is, a red flag. And I can tell you, CRA is using AI now to do analysis. They look at things like there are certain numbers that are higher probability of being fictitious than others. And they run a very similar benchmark analysis to the one that we do to see how you fall within the norm. And I would tell you, if you're falling below the norm, odds are you probably won't get audited. But I also wouldn't allow the fear of an audit to dissuade you from claiming deductible business expenses. If they are reasonable, if they have the ability to help your business earn income, and you've got the documentation, even if they're aggressive, I always say go with being aggressive because first of all, only 1% of the population gets audited. And number two, even if you get audited, it doesn't mean you're going to lose those expenses. And CRA is not this big bad devil that they are often made out to be. They are usually reasonable. And if you've got the documentation and you know what you're entitled to, you can usually keep those expenses. So I hope that answers your question. We got another question here from Kashav who asks, can we expense payments to subcontractors overseas? Absolutely. Yep. Quite common. Upwork, overseas people, but you got to have invoices and documentation to for those those appropriate subcontracting fees. But yes, absolutely, you can have subcontractors overseas. And one of the other things that we also talk about too, which isn't subcontracting, but is another one I thought of that we probably should have added to this slide, is potentially income splitting, which is another deductible expense because if you are paying your spouse or your children to help in your business, that becomes another expense to the corporation and is a way of reducing your total tax liability because even though they will pay tax on the income that they earn, if you had two individuals earning $50,000, that will be less tax than one individual making $100,000 because of the way our marginal tax system works. So income splitting, again, another viable way to make, I don't know if you call them personal expenses because we do, in order to be able to claim spouses, we do have to justify involvement in the business and the salaries must be reasonable. But there are lots of things that you could do to get your children involved in your business and justify fairly high salaries, whether it's helping with organizing your bookkeeping, whether it's helping you with your social media, whether it's helping you with your resume, whether it's helping you, there's lots of things that you can justify children and working in your business. And for your partner, your spouse, again, just being your financial partner and your advisor and your coach, legitimately, we can typically claim salaries of $30,000 to $40,000, and we've been able to successfully defend that for years. So again, thank you guys for joining us on this session today. If you do have any other questions and we don't get a chance to hit them today, feel free to post them into our social media channel and we'll be sure to follow up with them. Again, we've got great webinars coming up. I am particularly excited to share the one that will be coming up with the Economist, where we're talking about the budget. This is a very significant impact for business owners with retained earnings inside their corporation. It's also a significant impact for any individuals who own, any other assets personally, like cottages and stuff like that. Just a heads up, if you are looking to realize capital gains that are going to be over $250,000, either in your corporation, well, inside your corporation, there's no $250,000 threshold. But outside your corporation, if it's over $250,000 and you're to be subject to this higher rate, you do have till June 25th The deal has to be fully closed. So if you're selling a property, it has to be closed by June 25th in order to still claim the 50% rate as opposed to the 66% rate. And inside your corporation, unfortunately, after June 25th, everything is going to be subject to this higher rate. There are plans and strategies that we have in place, and there are ways to still leverage the benefit of building up wealth inside your corporation. It's just how you invest it is going to change. We're going to see a lot more insurance products. We're going to see a lot more IPPs as people do this. And this is, again, I swear I could throttle Krista Freeland and the government, because this is a terrible strategy, because all people are going to do is change how they hold money, and it's going to move to different tools. So what's an IPP, Linda? It is a individual pension plan, sometimes called a PPP or a personal pension plan. So those would be pension plans for your corporation that you can now set up. And the good news is what did happen here in Ontario, and you can thank Ford for whatever you think of him. He did make it less onerous to set up a IPP or a PPP inside your corporation here in Ontario, which means it's cheaper to do and more approachable for small businesses. And what an IPP is sort of like, it's like a RSP on steroids. The money goes into your corporation, it's invested in the IPP. The corporation gets a deduction, which reduces its taxable income. The individual pays tax when they pull the money out of their pension in retirement. And I call it like a RSP on steroids, because you'll get more room in an IPP than you will in an RSP. So if you've got someone who's maxed out all their RSPs every single year, an IPP can be a way to get virtually like the same strategy, but more room. And then insurance products are great because they're not subject to capital gains. They are, when you receive your benefits, they come into something called a capital dividend account. And the beauty of the capital dividend account is it can flow out to your shareholders completely tax-free. So there's always been lots of great advantages in insurance products when it comes to tax. They were often outweighed in many cases by the limitations on what you can invest in inside of an insurance product, so to speak. And so they didn't share the same growth potential that you could see by investing in stocks and puts and calls and all those fun things. But if we're going to be paying a substantially higher rate on investments inside the corporation, that makes them a lot more attractive now. So I hope that answers your question. And like I said, we'll be discussing this in much more detail. I don't think we've released the date yet on that webinar, but I can tell you we were just in our marketing meeting earlier today, going through and approving the content that we'll be putting out. So that'll be coming. So keep your eyes peeled. It'll be coming relatively soon. So again, go and check out our events page, cpa4it.ca/events, and stay up to date on all these webinars that we do. And again, if you have any feedback, there's a specific topic you'd like to see or hear, let us know. The purpose of this is to drive value and help you guys get more value out of your businesses. And as we always say, to help you organize your finances, create wealth, and transform wealth into a legacy. So thanks again, everyone. Have a great day, and bye for now.